Welcome to today's video on key financial indicators. As a financial professional or investor, understanding the financial health of a company is critical to making informed investment decisions. So sit back, grab a notebook, and let's get started. Let's learn what a company is all about by analyzing its financial statements. Financial statements are a must-have for any company that is traded on the stock exchange. They are released at least once a quarter, mandatory. Financial statements of publicly traded American companies are usually published on their investor relations website and filed with the Securities and Exchange Commission, SEC. The SEC requires public companies to file annual reports on Form 10-K, which include audited financial statements, and quarterly reports on Form 10-Q, which include unaudited financial information. Companies also file other periodic reports and announcements as required by SEC regulations. All of these reports and filings can be accessed through the SEC's EDGAR, Electronic Data Gathering, Analysis, and Retrieval database. We, as investors, need to pay attention to GAAP. GAAP stands for Generally Accepted Accounting Principles. It is a set of accounting standards, guidelines, and procedures used by companies in the United States to prepare and report their financial statements. GAAP is based on a set of principles and conventions that have been developed and established over time by the financial reporting community, including the Financial Accounting Standards Board, FASB, and the Securities and Exchange Commission, SEC. The goal of GAAP is to provide a consistent and reliable framework for financial reporting, which helps to increase comparability, transparency, and accountability in financial markets. Financial statements have many lines, and each of them means something to us. It's important to pay attention only to the most important business indicators: equity, liabilities, revenue, net income, dividends, and the company's value or the stock price itself. All these indicators, except for stock price, are in the financial statements themselves. Let me reassure you, you don't have to delve into each report to find out some values. There are plenty of cool free services that store information about these values and provide it to users in a decent format. But you should know that the primary source of data in these services is always the financial statements. Company's equity is all assets that belong to the shareholders. In the beginning, this property was formed by the first shareholders and then increased year by year due to net income. Basically, equity is all the shovels, steamboats, machines, or factories that a company has and, importantly, legally belong to the shareholders. The main production assets will be simply referred to as shovels, which are used to make goods and services that are sold later. As you see, these shovels can be purchased not only from personal funds or business profits, but also through taking out a loan from a bank. The shovels purchased with borrowed funds may have a lower quality as compared to those purchased with personal funds due to the added cost of interest, but they offer the advantage of being able to immediately increase production of goods and services. These shovels that the business purchases on credit are reflected in the financial statements as liabilities or debts. If you take all the shovels purchased by the company over its lifetime using its own resources and combine them with the shovels purchased on credit, you will get a figure referred to as assets, that is, all the property of the company purchased both with its own funds and borrowed funds. Business is not equal to the sum of all shovels. Shovels are purchased to dig pits and sell them to the population. If our pits are purchased, the company's revenue grows. Revenue is a real indicator that the business's goods and services are needed by someone. If revenue is growing, everything is good for the company. But getting revenue does not mean earning from it. After you receive money from the population for the pits you sold, you will have to pay salaries, pay off credit, pay taxes. And what remains will be called net income and will belong to the shareholders. To obtain a net income from a company, it is necessary to hold shares of that company. Furthermore, the business must make a decision to distribute this clean profit through dividends to shareholders. There are alternative ways for the company to utilize this net income, such as acquiring more assets, expanding the business, and potentially generating even more profit and thus, larger dividends in the following year. By buying even one share of the company, you become a real shareholder and all the indicators listed in this video now belong to you. It is now simply a matter of comparing the stock price with the business performance. This will be covered in further detail in the next video. Don't miss out on our next video where we delve even deeper into the world of financial indicators. Make sure to subscribe to our channel to stay updated and continue learning about how you can make informed financial decisions for your future. See you in the next video.